Hello and welcome to Trade with Raymond. Um, it's been a long time since I did a video, and this is going to be a video series focusing on the appropriate use of technical analysis. I call this video is 101, and the idea here is to extend my knowledge of technical analysis to anybody who is interested in watching this video. And also, there's a bit this misconception that technical analysis is dead, and especially the use of Western technical analysis, such as using moving averages, using oscillators to trade. There's a misconception that they are always late and they are not effective in trading. Well, I whilst you follow these videos, you will get to a point where I'll be putting the tools to live trading and we cannot ascertain how effective they are. You see, the idea of technical analysis has been developed over 100 years now, and those who brought the idea or who invented the methods are very meticulous or were very meticulous, and they have used them in live trading for many years, and the results are there. Most hedge funds will look at the 200 moving average, but there's a reason why they are looking at the 200 moving average because there's enough quantitative data to prove that it makes money. Also, there's a reason why they use a 100-day moving average, a 45 moving average, a 15 moving average, 21 moving average. Most of the time, people pick up trading tools and ideas off YouTube, and most people who display these videos may themselves haven't spent enough time researching into the tools. And so as we start building a trading system, I would like you to watch closely. Also, I also want you to point out particularly that trading involves a lot of risk, and therefore it's important not to use your house money or your school fees to venture trading. You should put in risk capital or capital you're willing to lose. Should you lose? Now, having said that, this is an MT4 chart. In trading, you need a platform, either an MT4 platform, a web-based platform, downloadable platform, a Microscope 2.0. There are so many trading packages out there. You will have to research your broker effectively to be sure that he are licensed to give you what he are giving you, and so that you don't have a situation whereby you fund a live account but it's not really a live account, or you want to withdraw and you can't withdraw, or the trader folds up and takes your money away. So that research is very important before you get involved in trading. Now, from the face of the chart, we have a currency pair. In my view, technical analysis is devoid of the currency pair. We are looking at trend behavior, we are looking at price behavior, we are looking at the behavior of price in relation to the tools that we have on the chart. So it must work in or on every instrument, because some people adopt technical analysis and they say, okay, this technical analysis only works on this instrument, doesn't work on that instrument, and they create all videos. Anytime you start to hear things like that, that should be suspicious, because a truly time tested technical analysis tool works on any pair because the logic is the same, and technically market behavior over the last 100 years is very similar. So if you have a tool and you're told this tool can only work on indices, it doesn't work on currencies, and it only works on stocks or works on bonds, and it doesn't work on this other tool and this other instrument and that other instrument, you should be worried a little bit, because it means that the person doesn't understand fully the use of that technical tool, and maybe just be projecting it on one instrument or one asset and making fast out of that. So these technical analysis tools I'm going to talk about can be applied on any instrument, whether Bitcoin or cattle or cotton or sugar. It can be applied there because there's a strong logic behind how they work. I want to show you something. In this chart, you have a list of moving averages. And let me go to the hourly chart. Let's say you have a 24 moving average on an hourly chart. Since this is an hourly chart, it means that every price takes an hour to form and to close. So if you have a 24 moving average, simple moving average, it means that it is tracking price the last 24 candles. So that is the last 24 hours. Now, I'll be talking about scalping here, or really trading on a short time frame, not necessarily aggressive scalping. And so if I have a moving average, let's say I have three moving averages here actually. I have one moving average is 48, one is 96 moving average, and one is 144 moving average. Now, on the hourly chart, they are tracking price. This one is tracking price 48. It means that for the last 48 hours, it is telling us that the market is bullish. Bullish means that the price is above the moving average. And this is 96. So 96 is also giving us more than 2 days of price movement. And we have 144. Now, if I drop this to a 15 minutes time frame, it begins to tell us the story in also a unique way. Because I have reduced the time frame, it also reduces the spectrum of coverage. On the 15 minutes, this is a 42-minute moving average. It means that it is no more going to be tracking the last 2 days as it did on the hourly, but once we are on the 15 minutes time frame, it's tracking the last 12 hours of price behavior. The 96 is now going to be tracking the last 24 hours of price behavior. And this one is going to track the last day and a half. That's the 36 hour, the last 36 hours. So now with what you have, you are now able to project what is likely to happen because you are able to see what has happened in the last 12 hours, in the last 24 hours, in the last 36 hours, based on this moving average. So that gives you an idea of what prices are doing. In technical analysis, we call something the gold cross and the death cross. The gold cross is where you have the smaller moving average going above the bigger moving averages, and the bigger moving averages stay below. So, for example, this is a 2048 moving average. It's a shorter term moving average, so it rises faster to the occasion, followed by the 96 moving average, and followed by the 144. Maybe you like the popular 50 moving average, 100 moving average, 200. They work the same. But when you come to a shorter time frame, you may not be tracking price properly if you are using those big moving averages, but then you are using them in a simple moving average form. For them to be effective on a smaller time frame, you have to switch them from simple moving average to exponential moving average. So they track price faster and are able to tell you what is happening. But the principle is the same. The gold cross must be effective, or the death cross must be effective. So the opposite of gold is death cross. So let me look at, so from what we see now, we have a gold cross and we say prices are going up. So a trader must be interested this moment in looking at a bullish market. Let me bring another one here. A trader over here must be interested in looking at the bearish because we have a death cross. We have the red here, we have the yellow here, we have the green here. I am using these numbers, and if you look at my chart, I may suggest to you to use the same numbers so that if you have a question and you show me a chart, I'll be able to interpret what you're telling me because you're using the same colors. Similarly, also here we have the wonderful. So for those who say, well, moving averages are not effective, it is giving you a story. So from the first one, you have a story of a sell. The second one, you have a story of a massive sell. The third one, you have a story of not to do anything because you have them mixed up. This is not a gold cross. This is a mixed up cross. So you have the red leading instead of the yellow following is rather the green. That's a problem. You have to leave that trade. Then you have this. It's also another mambo jumbo mixed up. Then you have this. It is in order, and therefore a trade can be established here. You also have this in this pair. It is now trying to set up here. You have this happening. You see, the reason why using these three moving average and not two, it's important because you are able to see the speed of market movement. So in my trading, I always suggest traders to try and stick to not less than three moving averages. So you shouldn't go above three moving averages and you shouldn't stay below three moving average. If you watch this space closely and you subscribe, you're going to see how we're going to make very profitable trades using these methods while we build our trading system. So similarly like that, and then you have the same behavior. The market is moving, and then you have market dropping over here, and you have for gold, you have this happening for gold, and then you have the S&P 500, which is it started, it fell down. The reasons why we go forward, we will get to learn that. And this is a mixed up, even though crude oil is falling, there's no need to go for it. And the Japan index, and then basically that. So what I want you to take here is that we have the gold cross and the death cross, and the appropriate use of these tools in your technical trading and leveraging on their behavior will give you much better and much smoother trades than just trading the bear chart. These tools have been tested for many years. Personally, I started using this tool some 15 years ago, and I can tell you how effective it is. So thanks for watching my space. Ask your questions and get ready while we build this trading system to live trading. Bye bye.